Hey, welcome back to my finance coaching channel. My name is David Tan and I'm a qualified chartered accountant. I'll be coaching you in layman terms so that accounting and finance is made simple and can be easily understood by everyone. In the previous two episodes, we went through the balance sheet and income statement of Google with data taken from the Wall Street Journal. Today, we'll complete the series by looking at Google's cash flow statement. Are you ready? Let's go! For those who are new to this channel, we are on a series known as Finance Made Simple. The fundamentals of this series are the three basic financial statements. Today, we'll go through the cash flow statement. If you have not watched the other two parts, you'll be good to do so as the financial statements are linked to one another. I will provide you with the links to the videos in the description section below. As usual, let's look at the definition of what a cash flow statement is. Investopedia defines the cash flow statement as follows. A cash flow statement is a financial statement that provides aggregate data regarding all cash inflows a company receives from its ongoing operations and external investment sources. It also includes all cash outflows that pay for the business activities and investments during a given period. So, the formula for the cash flow can be simplified to net operating cash flow plus net investing cash flow. The net cash flow refers to the aggregation of inflows and outflows of cash in each category. Placing the definition side by side with the formula, you will see how simple the definition really is. Taking the simple formula, we will add two more components, which is net financing cash flow and exchange rate effect, to arrive at the final net change in cash. The reason that these last two items are not in Investopedia's definition is probably because they are not so common and do not happen in every accounting period. For example, financing activities such as raising capital through stocks or taking a bank loan to finance the business. Exchange rate effect refers to foreign exchange gains or loss that happens during any of the above three categories of activities, namely operations, investing, or financing activities. Now we shall go to the Wall Street Journal to look at Google's cash flow statement. If all the lines are collapsed down to the three main categories of cash flow, this is what we will see. And here's where we expand the categories and choosing to look at the quarterly view of the cash flow statement. As usual, I ported the cash flow statement into an Excel sheet to simplify it while retaining all the original numbers. That way, you'll be able to see the main components of the cash flow statement and how it relates to the formula. The cash flow statement starts with net income. This is taken from the income statement. To refresh your memory, here's the income statement which we went through in the previous episode. The net income is highlighted in the red box. Back to the cash flow statement. Starting with the net income, we will need to add back items in the income statement that are not cash in nature. For example, though depreciation is part of the calculation in the income statement to arrive at net income, it is not part of the cash flow statement. Therefore, when we start off the cash flow statement with net income, we will need to do a reversal by adding back depreciation. We would then arrive at funds from operations. Changes in working capital refers to the net movement in the next 5 lines below it. For example, a negative in receivables indicates that cash which would normally be in the bank is not yet collected and remains as a receivable. A positive accounts payable is a good thing for cash flow because it means that the business is using the credit line which is extended by its suppliers and therefore increasing its payables. The extra funds can be used in short-term investments such as a placement in overnight money markets to yield short-term interest income. Adding funds from operations and changes in working capital will give us net operating cash flow, which I had shaded in orange color. This is one of the 4 components in the formula to arrive at the net change in cash, aka net cash flow. The next orange shaded component is the net investing cash flow. As the name suggests, it is cash flow resulting from investing activities such as capital expenditures, which are investments into the business, and purchase and sales of other types of investments that are not related to the business. The next 2 orange components are related to the financing activities and exchange rate effects, which I had mentioned earlier in the video. Adding up the 4 orange shaded items will give us the final net change in cash. I would like to make a quick mention of the free cash flow, which is the line item right below the green shaded net change in cash. The formula for free cash flow is net operating cash flow plus capital expenditures. Free cash flow is a very valuable indicator of a company's stock value, as it represents a company's ability to pay dividends, buy back stock, and facilitate the growth of the business. This is just a good to know information for this Finance Made Simple series, as it is already going beyond its scope of keeping things simple. We will probably be revisiting this in future episodes as I touch on companies' valuation and investments. I hope that you have found this series helpful, and if so, please share the video with your friends and colleagues. To continue following this finance coaching channel, please remember to subscribe and activate the bell icon to be notified of future episodes. Till then, take care and stay safe.